Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes on Options Guide TV. All right, well, is this the bottom? I read one article saying you should hold your nose and just buy. So I thought that made me chuckle, and because I do kind of feel like that could possibly be the case. April 2nd is going to be a big day, and I mentioned that on the last show on Friday. So today, if I'm looking to do anything in the S&P 500 index after seeing a little bit of strength in the markets, we got the VIX actually down around the 18 level, so a little less uncertainty in the marketplace. 18 is not a bad level considering the trials and tribulations we've had over the last actually 5 weeks. We didn't quite. I think we weren't positive last week. It was 4 weeks in a row. That was going to be 5 weeks in a row. And I actually don't know if we ended up actually having a positive week last week. If we did, let me know for the markets, if there's somebody out there that knows that answer to that question. So in the SPX, I wouldn't mind. I think an iron condor is an interesting trade, just to go wide and sell an iron condor in the S&P 500 index. I'm going to do just a skip strike butterfly. I'm going to change it up a little bit because I want to change things up a little and try some new strategies. I've done a lot of iron condors with the VIX still elevated, and I do feel like the marketplace does have some upside. I'm going to do a short term skip strike butterfly. But now remember, this is an alternative, and this is the way I've always approached these trades to doing a short call spread. So I'm going to spend a little bit of time on it today on the SPX. And then I want to revisit our trade that we did a few weeks back, I guess. Now it's been about a couple of weeks in AMD, because AMD is having a strong move to the upside, and we got bullish with a bull call spread in AMD. So we're going to take a peek at that trade. And then NVIDIA is bouncing pretty nicely as of late. We looked at a covered call on steroids, and we build it that way on Friday, and I mentioned that in almost all of the Meg 7s that it was feasible to do that type of trade because they were all down, and you need to have some volatility in order to pull that trade off, as opposed to doing a covered call outright. So NVIDIA is up $4 today, or about 3.25%. All right, so let's run to the Tradier Pro software. There we are. And we'll start in the SPX. So I was going to put the trade in, but here's what I want to show you how I will set this one up. We're only going to get 5 points of upside. We're going to do the March 26th expiration, and I triple checked to make sure that that is Wednesday. So this is March 22nd, and that's a joke for the people that on the last show when I couldn't figure out which one was Wednesday. But the market's at 57.58. We're going about a one standard deviation move out of the money, 57.60, and here you are, March 22nd, 2 days away, 58.30. Okay. So we might do two of these this week. So keep that in mind. And that thought is in my head because I was going to try to decide if I want to do a bigger credit or a little credit. Okay. If I set it up very tight, a very tight window, we're going to, this is right at, what delta is that? 14. Okay. So 14 delta, meaning a 14% chance that it might get to that underlying. All right, let me just let's set up the butterfly. Okay, buy this one. We're going to sell two of these. We're going to skip that. We're going to buy this one. All right, and we got to delete that. Buy, sell two, skip, and buy. Okay, so if we look at this trade, we're looking at a 40-cent net credit to the account. So let's send this to the what if. Remember, it's got all day today, all day tomorrow, well, the rest of the day today, all day tomorrow, and it will close at the end of the day on Friday. Pull this down. And zoom in. Okay, so our risk is from the skipped strike, which is 58.40 right here, right where we cross the zero line, down to 58.45. Looking at a 45 cent net credit, that seems about right. 45 would probably be solid. We're going to make it 45. I think we could get filled at there. And you have $5 of risk, so that's $500. Implied volatilities are up. That will help in this scenario, and it's part of the reason why I want to do a skip strike butterfly now, but in the SPX in particular. Well, the VIX is still a little bit elevated. It's not 22, 23 like it was before, when we were getting off very cheap open wing butterflies on the downside. Now we're looking at a skip strike butterfly, thinking that if the marketplace does come up towards this level, it's very important that we're only doing 2 days. If we did a week, we could probably get a little bit more, but if I did a week, I'd want to go wider on the butterfly. Instead of 5 points wide, I'd like it to go 10 points. Time decay is going to be is going to be your friend if the market starts moving towards your middle strike. So with the market at 57.61 right here, this is, I clicked that button. This is your profit and loss as of now. Okay, now I got to zoom back in. As of now, it's going against you if it ran up to this level, but tomorrow that line will be there. And then Wednesday, the line will be somewhere in the middle of the body. And then at expiration, this is where it would end up. So if I look at this trade, I put it on, I do need time decay to go away, and I do need implied volatility to come in. All right. 45-cent net credit to the account. Max risk is $5 minus that 45 cents. So $4.55 is the max risk. If we just sold the trade, if we just went out and we sold the 58.40, because I think this is important. If we were just going to do a 5-point wide credit spread, 58.40 to 58.45, that would be 5 points wide. If I just look at the bid to bid, you're talking about 330 minus 285. That'll give you somewhere close to the midpoint. Well, in that instance, that's only 45 cents, which is what we're getting on this entire trade. So let me adjust it. Let's just go do the trade then. Yeah, we got that in the skip strike. So here's the alternative. You do not make it a skip strike, but you sell the 58.40 and you buy the 58.45. Yeah, 55-cent net credit. Okay. So if you did not do the skip strike butterfly and you just wanted to do a far out of the money credit spread, the trade there where our risk kicks in on the skip strike butterfly is at 58.40. That's the strike that we are skipping. 58.40, 58.45, that's 5 points wide. You could get it done for a 55-cent net credit. We were able to get our trade done at that moment for a 45-cent net credit. We have our buffer in that we have the butterfly, but it ends up that basically the butterfly is trading for about 10 cents. So it's a very inexpensive butterfly. So we're only taking a dime worth of our net credit here to get this trade done. So not a bad alternative, right? And then you have your hedge embedded in the trade. Now, it's not a great hedge because we're only 5 points wide on our butterfly, but it is a hedge nonetheless. And we only have 2 days for this trade to live. And the only reason why we could probably do this and get this done for a decent net credit is because the VIX is up a little bit. Vol in general is up overall. So let's go back and remove this strike. And let's clear it out. We'll go to the what if calculator, and I'll show that to you again. And let's see if we're still trading at 45 cents. We can get it done for 50 cents now. 45. I think 45 is the number. 45, I think, is where you could probably get a fill on this trade at. So not a bad alternative. And if you're thinking about doing some type of strategy like that, and obviously if you go wider, I always try to keep things tame here on Options Guide TV. $500 of risk on a one butterfly, 1 by 2 by 1 is a learning trade. It's a trade that you can work with. Now, if you go a little bit wider, it's a little bit harder to get it done for a net credit to the account, but you would have to go out a little bit longer. And then that trade changes dramatically because of if the market starts going against you, time decay isn't as explosive, I guess. Time decay just isn't there. It's just not as quick as if you did just the 2-day trade. But if you get this done for 45 cents on your $500, and then you turn around and you can do another one on Friday, get another one done, you're doing fairly good over the week if you could pull 2 of these off at that price. Now, if it lands right here, we're good. We're solid. So we're going to watch how this thing prices out. I don't think we've done a skip strike butterfly in quite some time in the S&P 500 index. The VIX is still a little bit high, a little bit elevated. Vols have came off, though, just across the board. And this might be our last opportunity to try to really approach this trade this way. An alternative would be to do the same 5 points wide on this side and go down and do the put side and do an actual iron condor. And that's an alternative trade to this. But I think I like this. And actually, there's no reason why you couldn't do this one on the other side and do it on the put side too. So you do the call side about 1 standard deviation away, and you do the put side about 1 standard deviation away. Put's a little bit harder to get done for a net credit, though. That is true because of the skewing of the puts, especially in the S&P 500 index. All right, no questions. If you have any questions, please do put them in the chat box. I'm happy to address them during the show. Now let's go and look at our AMD trade that we set up, and I'm going to grab my screenshot and look at the expiration that we have, 4/17. So we went out quite a bit in time, and we did say that we might adjust this trade because we're quite wide on it. We bought the 100 strike call in AMD with this expiration, April 17th. So here's the 100. Right here, okay? So let's clear this out here, and let's see where our trade is at. We're buying this, and we sold the 125 all the way up here. Still got some juice in that one. Sold that. Okay, $13. All right, so we're up a good bit on this trade. We put the trade on for $7.70. We're trading at $13.02. So we'll call it $13. Right now, 13 minus 770, quick like this, $5.30. So strong gain on this position, $5.30, almost a doubler. Usually, if I would put a bull call spread on like this and we were up, you put it on for 7 and you took it off for 7, that's where we would be at. 7, but we're at $5.30. Now, Where the stock, when we put it on, the stock was at 104. We bought the 100. We're now at 113. So I'm going to look at this adjustment. Our option contract is $14 at this point in time. If we sold that and we rolled up to the 110, how much money? We got to be able to get done for at least even. Okay, so here's a potential roll, and maybe I'd wait just a little bit. It leaves us with 12 points. Yeah, this is feasible here. Okay, let's see, 14. We can do 1360. Let's 13 would give us $12 more of upside. All right, so if you wanted to take some money off the table, here's an adjustment that I've done from time to time when I do really wide call spreads and you have a lot of time remaining to expiration. We still have 24 days because you're in this situation, you're up $5 on the trade, which very solid trade in just in general, and you can get out. There's no problem just with getting out of the trade. But if you do see some more upside in the AMD, which I do actually, it hit a really strong resistance level to the downside that was established a long time ago, a very strong one. It made a real good bounce off of that. So here we are, 100 to 113. Let's remove this strike, 120. We still got there. It's still got $1 worth of time premium in it. So there's still worth holding this and not closing this out because there's still some time premium in it. We got the 120s here. This is going to be a sell to open. And then we're going to switch this up and we are going to buy, let's do the 113. And I'll bring this down and I'll do it this way. And this will be a buy to open. So $9.43. Now remember, we still got the 125 option in here. And that still has some premium in it, still trading for $1. So by doing this, we put the trade on for $7.70. We'll call it 945 if we could fill at the midpoint. So 945 minus 770 is $1.75. So we do this roll. We pull in $1.75. Now that's a solid trade. Just in general, we made $1.75 on $770 investment. Nothing wrong with that, but we still have a position on, and that position, as expiration approaches, could, if we do hit the 125 level, that means that this thing could trade for as much as $12, which is the difference between the strikes from 113 to 125. So we put this trade on. Mentioned on the day of the show that we could look at an adjustment because we are wide enough. We are making some money on our 125 option contract, mainly because it is so far out of the money that when we first did it a couple of weeks ago, there was still some time premium left. So the trade is a real good learning experience in that this is the exact scenario where you might roll it up and within the same strike. So you're it would just be a roll up of the trade. You sell the one that you own, you roll up to the 113, and you're sitting at the 113. You remove the risk of the trade, and it's also on a big up day, up 6%. And then you still have from 113 up to 125. And if you get the momentum, you still have the momentum on that trade. That could work. All right. So do we have any questions on the adjustment of the trade? All right. So far, so good. Let's go in then and look at Let's look at the oh, there's the comment. Okay. Oh, Anthony, did you do the trade in AMD? Kind of wondering, did you end up doing that trade? Because that is an interesting adjustment. Now you can let it ride. It does cost you. Obviously, you got to roll. You have a bid ask spread that you're dealing with, and yeah, you can take some money off the table and make sure that it's a winner no matter what. Okay, now if we go back to, let's look at NVIDIA. Let's see where we're at. All right, thank you for sharing. As my son says, Anthony, sharing is caring. And let's go back, look at NVIDIA. And let's just see where our trade is at in NVIDIA. And I did mention I put this trade on in my account. So 120 to 125. We did it on that day for a net credit of 70 cents. And remember, you got to have 100 shares of stock. And I also did one of these in my Google position too. And these were retirement monies. And that's where I own stocks in a lot of my retirement accounts. And I did NVIDIA and I did Google, and I both got them done. Google was a lot harder because it just doesn't have the volatility that NVIDIA does. You need to have pumped up vol in order to pull these off. NVIDIA isn't bad though. Just in general, at 40% vol, Google's down around 25, 30%. And that difference in vol makes it a lot harder to get it off, get fairly decent wide and get it off for a decent net credit to the account. 120 to 125. The expiration date is April 14th. No, April 17th. 417. Yes, 417. 70 cents. All right. 24 here. 24 days. Oh, so we're actually in the right expiration. 120. Clear this out. Buying the 120, and we sold 2 of the 125s. Now this one's a little bit tighter, so it's not going to look as impressive, and it's not. It's all right. We put it on for a net credit of 70 cents. You can take it off if you wanted to, and I wouldn't do that in my account. I don't plan on doing it, but you could take it off for a well, actually, we're going to be down a little bit on this, right? So we would sell to close this and buy to open that. Yeah, so we're actually down a little bit on the trade in that it's at 125 right now. So we need time decay to start happening on this trade. Send it to the one, what if, it's upside down. So we need time decay to start eroding on this trade in order to make this trade more profitable at this point in time. But we have the long option contract gains are not offsetting the short option contract losses. So stay the course with it. I like that the stock has bounced back. It's just bounced back too fast. Now, our issue here, we really don't have an issue in that we are long this 5-point wide spread. If the market continues on up, you might have to roll this one or decide if you want to sell your stock. So if NVIDIA continues strong, we still got 24 days remaining. If this even 10 days away, if it takes 10 days to get to this price at 125, well, in this situation, then this trade will probably flip and become profitable, where this option contract will trade for more than this option contract, quite a bit more than doubling those two up. So interesting trade. It's where we're at. 122 on NVIDIA. We want it to slow down in theory. If it comes up to 125 and you don't want to sell the stock, we'll look at rolling that one option contract. And if that does happen, remember, we're going to have the benefit of getting $5 from our long call spread to go along with that. So that's how we would make the adjustment on the trade. And this is actually the way that we would approach it if we were just short a call option. if we had sold some premium on the 125 strike call. Now we know that as expiration approaches, if it hits the 125, we're also going to make $5 on our long call spread. So time decay is our friend here, and it wouldn't hurt us in that scenario. And there you have it. Any questions on that one? All right. And I have one other trade in, and I have that trade in on Google. I did much a similar thing. Where's Google at today? 167. That's up 2% on the day. So the Mag 7s are finally coming back, looking strong. Apple is up again. I noticed that. Amazon is up 275. And the banks are doing well. I think financials in general are a good place to be. I wouldn't mind owning some of them. They got really beat up, and they just didn't deserve what happened to them. So if you like, as far as a safe play, I'm not talking about a momentum play. I think financials are solid. Now, I guess there were concerns about recession, and people were thinking the financials were going to get beat up, insurance or rates are going to go higher, and that just hasn't happened. Insurance rates are drifting downward a little bit. The Fed's not going to cut. Now they're going to cut. Maybe they're not. There's still a probability that they may cut at the next meeting, about a 25% chance at this point in time, according to the Fed Watch tool. So there is still a chance that they may cut at this point in time, and I think the banks are reflecting that. All right. I think that's it. Yeah. We're 25 minutes, almost 26 minutes, almost exactly. So any other questions? I like the NVIDIA trade. I would consider rolling it, or AMD. I'm sorry. I would consider rolling it at this point in time. NVIDIA this isn't a bad scenario right now that we put it on for 70 cents. And right now we're down a little bit on the trade, but time decay is our friend. It just came back too quickly, but it's once again, it's the same type of issue that you would have if you had a covered call position on, except we do know that if the stock goes up and as it approaches, the actual long call spread that we have is going to be worth $5 if it hits the 125, which will offset some losses that we would have on the one short call that is covered by our underlying stock. That's it for this edition of Options Guide TV. Please follow us inside the hub.tradier.com. If you haven't set up a profile, please do it. It's free. You have access to all the different speakers and a lot of nice little playlists so that you can watch unlimited episodes of Options Guide TV if you would like. Also follow me on x.com. My handle is @BrianOverby. You can watch this event via x.com and also on the Tradier Twitter handle or X handle. Hard to say that. And lastly, we'll be back on Wednesday at 11 a.m. for the next edition of Options Guide TV and see how our skip track butterfly pans out. All right. See you Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.